Today, we're going to be doing a deep dive on the CFA topic of options strategies. And here's an example of a question that a candidate struggled with on the exam day, and one that could be asked in a number of different forms or fashions on exam day. So we're looking at what price does a call or put strategy break even, so calculating a break even price for a call or put, and how do profit and loss diagrams differ for single options and multi-leg option strategies. So before we dive into that question and take a deeper look at options and related strategies, let's first address why this topic and why this deep dive. Well, the derivatives portion of the exam is meaningful, and you'll likely see multiple variations of options on exam day. The candidate error rate's a little under 50%, so if you can aim to achieve a score well above 70%, then you should be in good shape on exam day. So clearly this part of the exam and this specific topic has been a challenging area for CFA candidates, and some of the common pitfalls that we've seen are confusing long and short positions for options and the related payoff implications for each side of the trade, forgetting to subtract the premium paid for the long side of an option. So calculating, for example, the intrinsic value of the option when it is exercised without backing out the premium for a long when calculating their profit and loss, misidentifying break-even points for multi-leg option strategies. For example, looking at an option straddle and only focusing on one particular side of that trade or another. The reason why this might be a little challenging for candidates is because it's not just about memorizing formulas. So as a rule of thumb, the CFA exam is not a formula memorization or a mathematics exam. You'll certainly have to know formulas for exam day, but what they're really trying to test is your analytical ability and your ability to understand key concepts and apply them to situations as an analyst or a portfolio manager. So the edge that we hope that you'll gain through this deep dive is for the questions that you see on options on exam day, by having a solid base of understanding, not only with the key formulas, but more importantly, for the key concepts and being able to apply them. That should give you a leg up on this part of the curriculum. So to start, some key definitions and concepts and a basic overview for options. A call option is the right to buy in an underlying strike. A holder of a long call option has the right to buy at a specific strike. Their max profit is uncapped. It is the underlying price, let's say for a stock, less the strike on the option minus the premium. The max loss for a long call is going to be the premium that they paid to purchase the option. A short call has the opposite payoff diagram. They have sold a call option to the long call. They've collected a premium. Their max loss is uncapped. It is their premium paid less the difference between the price of the security less the strike price. So in theory, the max loss for a naked short call would be uncapped because the price of an asset, let's say a stock, has no specific upside cap. A put option is the right to sell at an underlying strike price. For holders that are long a put, their max profit is the strike price of the asset less the price of the security less the premium. So for a stock, for example, you would look at the stock's price. If it is below that of the strike, you would have a positive profit net of the premium paid. The max loss, same thing as for a call. The max loss for any long option holder is going to be the premium that they paid. Key thing to remember, an option is a right, not an obligation. So if the option is not in the money, then it will simply expire worthless. and the long will be out the premium but incur no further loss. The short put or the put option rider, their max profit, again, is the premium collected. Their max loss is the premium less the amount the price is below the strike. So, for example, if it's a stock put and the price of the underlying stock is less the exercise price, the profit or loss for that particular short would be the premium less the dollar amount that the stock is below the exercise price for a put. The intrinsic value is the in the moneyness of an option. It is the difference between the price of the security and the strike price. For a call option, it is the price of the security less the strike price. For a put option, it is the strike less the price of the security. Key things to remember in terms of bullishness or bearishness as well. Long call holders are bullish on that particular security, bullish on the underlying. They are betting that the price of that security is going to go above the strike price. The short call or the call option rider is bearish. They are betting that they are going to collect the premium and the option preferably will expire out of the money, meaning the price is not above the strike price. The reverse is true on the put side. The long put is bearish, betting on the price of the underlying to fall below the exercise price and the option to be in the money. The short put option is bullish. They are betting that the price of the security will not fall below the strike price and they will simply collect the premium. The break even for a single call or a single put is the strike plus the premium. For calls, for a put, it is the strike less the premium. And we'll look through some examples in terms of how to calculate break evens for single calls, single puts, as well as for option strategies as well. So here we'll look at a basic example for a single call option. We have a portfolio manager who purchases an American call option from a dealer on ABC stock for $3 a share for a strike of $50 a share. Currently, the shares are trading at $45. So this is an example where the premium is $3. The option is currently out of the money. In this case, for a call, the strike price is higher than the current price of the shares. So in this scenario, the intrinsic value is going to be 0. It is simply the maximum of 0 or the difference between the price of the stock and the strike price. In this case, since the price is trading below the strike, the intrinsic value is 0. The time value is the premium less intrinsic value. Since intrinsic value of this option is 0, the time value is simply the premium, which is $3 a share. I'll also note this is an American option, which means that it can be exercised anytime up until maturity. A European option can only be exercised at maturity. If the stock were to be trading at $60 a share and the portfolio manager exercises this option, the profit for the long would be $60 less $50 a share, which is $10 less the premium paid of $3 a share. The net profit would be $7 for the long. On the short side, for the dealer Tim in this example, the loss would be $7, the $3 per share that he collected, less the $10 in the moneyness of the option, which is the $60 less the $50 strike price. If the stock instead moved lower from $45 to $40, the loss for Andrew would simply be the $3 per share premium. This, again, is the right, not the obligation to buy. Since the option would expire out of the money, it would be worthless. And the portfolio manager, Andrew, would simply be out the $3 a share premium. The profit for the dealer, Tim, would be $3 a share. The option's out of the money. It's not exercised. Tim simply collects his premium from writing the call option. Now we'll look at a basic single put option. In this case, the portfolio manager purchases an American put sold by a dealer on, again, ABC stock with a $50 a share strike price, $2 premium. In this scenario, the stock is trading at $55 a share. The intrinsic value is again going to be zero in this case for a put because the option is out of the money. The current stock price is above the put on the strike. So the time value would simply be the premium. Since intrinsic value is zero, the put's out of the money. The time value would be $2 per share. If the stock were to fall to $40 a share and the portfolio manager exercises the option, it's now $10 in the money. For a put, it's the difference between the strike and the price of the security, which would be $50 strike less $40 a share on ABC stock. That's a $10 profit less the premium that the portfolio manager paid, which is $2. In this case, the portfolio manager's profit is $8 per share on the long put. For the short put, Tim, the profit and loss would be the opposite. He would incur a loss of $8, which is the $2 premium that he collected for selling the put, less the $10, which is the amount the put is in the money. If the stock then rose to $60 a share, Tim would collect the $2 profit. The option is out of the money, so it would not be exercised. The portfolio manager would incur a loss of the premium of $2. They would not exercise the option, and that would be the extent of their loss. So as you can see, different profit profiles based on the movement of the underlying for calls and puts, and different payoff profiles depending on the relationship of the underlying versus that of the strike. For long call options, they're betting on the price to appreciate above the strike price. For put options, the longs are betting on the price to decline below the strike. And then the rider or the short option is betting in the opposite direction. Now we'll look at covered calls and protective puts. A covered call is when a holder of a stock writes out of the money call options against stocks that they own. It's a means of generating income from underlying securities that they own, and it's a means of generating income from the premiums that they write against the position. It, however, caps their upside, given that if the stock were to rise above the strike on the call that they wrote, the gains on their underlying shares would be offset by the gains for the call holder that would be long the position that they are short. So for an example, we'll look again at that portfolio manager that owns 100 shares of ABC stock, which is currently trading at $50 a share. He writes an out-of-the-money call option against the entire position with a strike of $60, premium of $5 a share. When the portfolio manager writes this option, he will collect a premium of $500. It's the $5 premium times 100 shares. However, the future upside is also capped, and it's capped at $15 a share if the stock reaches $60 or higher. It's the strike on the call, which is $60, less $50, which is the current price of the stock, plus the $5 premium. If the stock were to appreciate above $60 a share, any gains from the 100 shares that Andrew owns would be offset from the loss on the call that he wrote that would be in the money above that $60 strike. So it again caps the maximum profit, but it generates income proceeds against a position that this portfolio manager already owns. A protective put is intended to protect downside for those that are long in underlying assets. So in this example, the portfolio manager owns the same 100 shares of ABC stock. They're currently trading at $50 a share and perhaps is concerned about the value of this security falling. So this portfolio manager is long a put option against the entire position with a strike price of $40, so $10 below the current value of the stock, pays a premium of $3 a share. So in contrast to covered calls, which are really intended to be an income generation mechanism for longs that a portfolio manager has or an investor has, in this case, a protective put is intended to guard against downside in a particular security. This could be, for example, an asset that has significantly appreciated in value, and the investor doesn't want to sell the position and realize a taxable gain, but they want to hedge against the downside, so they instead buy a put. In this scenario, there's going to be an initial cash outlay of the premium paid, in this case $300, which is the $3 a share times 100 shares. This is going to hedge the downside. The max loss for this security would be $13 a share. The strike less the current price of the stock less the premium, and that would occur if the stock price falls to $40 or below. So you can see, for example, if the stock were to fall all the way to zero, if the protective put was not on, then the portfolio manager would lose $50 a share. Instead, because they have this put option on with a $40 strike, they would only lose $13 a share in that scenario. It preserves uncapped upside because if the stock continues to appreciate, the holder of the security will enjoy that benefit uncapped, less simply paying the premium for the downside protection. Now we'll look at some other option strategies, and the key thing to remember here is it's important to be able to articulate the definition of an option strategy, but more important than that, what's likely to be tested on the exam day is how you can identify the profit payoff profiles for a particular set of options for a strategy, or to recommend an option strategy to achieve a portfolio objective. So in this case, we're going to look at call spreads, both bull and bear call spreads. A trader would put on a bull call spread when they are bullish on the underlying, and they would express this view by buying a lower strike call and partially subsidizing that with selling a higher strike call at a lower premium. So for example, you could have a portfolio manager who buys a $40 strike call option on ABC stock for a $6 premium that they pay, and sells a higher $50 strike call for a lower $2 premium. The net initial premium outlay would be $4, and that's calculated by looking at the $6 premium paid for the long call, net of the $2 premium received for the higher strike, lower premium call that they wrote. The max profit will occur between the difference in each of the strikes. So $50 strike less the $40 strike, $10 per share profit. If the stock rises above $50 a share, less the $4 net premium to put on the trade, the break even in this scenario would be $40 a share. It'd be that lower strike plus the net premium paid of $4. This could be, for example, an investor who wants to get long the underlying, or believes that the security is likely to appreciate in value, but not dramatically so, to where it's at or less than the higher strike call that they wrote. And this would potentially require less upfront capital than being outright long the security by buying the shares. Bear call spread is an investor who is bearish on an underlying security and is betting on the security either not reaching that lower strike call or depreciating below existing levels. The way they would express this view is selling a lower strike call with a higher premium and offsetting this risk or hedging the risk of rapid price appreciation by buying a higher strike call. They would collect a net premium for the position. In this example, you could have the portfolio manager selling that $40 call option for the $6 premium and buying that higher strike call for $2. They would collect a $4 net premium up front. Their max loss would be $6 a share if the shares were to appreciate to $50 or higher. And that's, again, just the difference between those two premiums, net of the $4 that they've received for putting on the position. So key things to remember about call spreads: they can be bullish or bearish, and that relationship is driven by which strike the investor is long and which option they are short or they have written. For bull call spreads, there is going to be a net outflow on day one, a net premium paid. Their max profit occurs as the stock appreciates above the lower strike up into the strike of the higher strike call that they've written. For a bear call spread, the payoff is opposite. The investor is bearish on the underlying security. They collect a net premium up front, and their max profit is simply that premium collected. They are long a higher strike call. They are short a lower strike call, and betting on the price of the security to preferably be at or below the strike of the call that they're short, in which case they would simply collect the premium and the short call would expire out of the money. A bear put spread occurs when the trader buys a higher strike put that is partially subsidized by selling a less expensive, lower price put. The investor is bearish on the underlying asset. They are using the proceeds from the lower strike put to partially offset the more expensive higher strike put. The example again, $40 strike put option on ABC stock for a $5 premium, and selling, in this case, a $25 strike put for a $1 premium. The net premium paid at the outset is $4 a share. The max profit on this position would occur at or below $25 a share. So if the stock falls below that level, at or below that level, the bearish investor will make $11 a share, and that's calculated between the differences of the higher strike and the lower strike, net of the initial premium outlay. The break even would be $36 a share, simply that $40 higher strike price less the $4 premium. And this is an example of an investor looking to express a bearish view on the underlying security. They're betting on the price to fall below that higher strike put that they're long, and they're partially subsidizing that position by writing a lower strike put. A bull put spread is the opposite. It is an investor who is bullish on the underlying, or at minimum does not expect the underlying to fall below the strike price of the higher strike put that they've written. An example in this case would be a portfolio manager selling a $40 strike put, collecting that $5 premium, and buying a lower strike put, a $25 exercise price for $1 a share. The net initial inflow for this side of the trade would be the $4 net premium collected. Their max loss would be $11 a share if the price goes $25 or lower. They, of course, are hoping that the stock price stays at or above $40 a share, and they simply collect their $4 a share net premium. Another option strategy is known as a straddle. This is an investor who is betting on volatility if they are long a straddle. This involves buying a call and a put option at the same strike with the same expiration. This trader is implying that they expect volatility to increase beyond what's currently priced in, although not sure of which direction. And an example of this could be an analyst that believes the company stock is likely to react either significantly to the upside or downside following an upcoming critical earnings release. This trader then buys an option expiring the day after the earnings announcement because he or she is unsure of which direction the stock will move after the announcement. And in this case is buying a put and a call on the stock at $50 a share. The premium for the call is $5 a share and $4 for the put. So for this long straddle, the net outflow is the sum of the premiums paid for the call and the put, which would be $9 a share would be the outflow, and that's also the max loss. There's two break-evens for a straddle. The first break-even is going to be the $9 plus the strike, which would be $59 a share. Lower break-even is going to be $41 a share. Key thing to remember is the trader is betting on volatility to increase. They do not care which direction that volatility occurs. They're just betting on an uptick in volatility with two break-evens, one to the upside, one to the downside. The max profit is uncapped on the long side. The shares could theoretically appreciate indefinitely to the upside if they were to react violently to the upside after the earnings announcement. The max profit to the downside is $41 a share if the stock were to go to zero, hypothetically, which is simply that $50 strike less the $9 premium paid. So if you were to be asked a question, for example, for an investor who is long a call and a put with the same strike price, what is their max payoff potential? It is theoretically uncapped because this investor is long both a call and a put. A short straddle is the opposite. They're betting against volatility. This could occur, for example, for a portfolio manager that believes the implied volatility for a security is too high. As a result, they take advantage of that higher implied volatility, collect what they perceive as an attractive upfront premium, and is betting on that volatility to subside. Their payoff potential is the opposite. They have an uncapped loss because they're short a call and short a put. So they have theoretically an uncapped loss. If the stock were to appreciate to the upside, their loss is capped to $41 a share on the downside. It's simply the reverse of the profit payoff we saw for the long straddle. So key things to remember for those long and short, the same strike price option. The long is expecting volatility to increase beyond what's implied by how the market is pricing those two options. Short straddles betting against volatility to subside, and they simply collect the premium that they receive up front. So now we'll just take a review of some of the key concepts. The call option profit is either zero or the difference between the underlying security's price and the strike, less the premium paid. Put option is the opposite profile, betting on the price of security to fall below the exercise price. Max profit is either zero or the difference between the exercise price and the price of the underlying, less the premium paid. For a call, the break even is going to be the strike plus the premium. For a put, the break-even is going to be the strike less the premium. Option strategies, as we've seen, can take a number of different forms: long and short calls and puts, straddles, strangles, looking at different option expiration dates and different option strike prices on the call and the put side. But the key thing to remember is to think through and remain focused on what side of the trade is being addressed. Is the trader or portfolio manager long or short? Are they long and short a call or a put? Are they bearish or bullish? What does their payoff profile look like? And what options strategy is appropriate given a portfolio management objective? So, for example, if the question asks or suggests that a particular portfolio manager wants to generate income from their underlying longs for the stocks that they own, a covered call would be an appropriate strategy. If a portfolio manager has a concentrated position that they don't want to sell to realize gains on the sale, but they want to hedge the downside risk of a concentrated holding, a protective put would be appropriate in that scenario. Of course, define the position being addressed, long or short, and whether we're talking about a call or a put option. and then determine the payoff at expiration, looking at the intrinsic value, which is the difference between the strike price and the exercise price. For an option out of the money, the intrinsic value is going to be 0. And always remember to subtract the premium that's paid when purchasing the option and to identify the break even where the profit will be 0. And again, that's net of the premium paid. Now we'll look at some questions related to options. In this scenario, we have a portfolio manager calculating the payoff for 2 put options on the British pound. So betting on the British pound to fall below a certain exercise price. These 2 options have different exercise prices. So the first put option has an exercise price of $1.25. The second has an exercise price of $1.75. Both are going to be 100,000 British pounds. The underlying is selling at 1.438 pounds. So the question addresses what's the payoff of each of these long puts. And in this scenario, the $1.25 put would be out of the money, so it's going to have an intrinsic value of 0. So we know that the payoff is going to be 0 because for a long put, you can't have a negative payoff. The put option for $1.75 is going to be simply the difference between the strike minus the price times 100,000 pounds, which is going to equal 31,200 British pounds. And again, that's just taking, for a put option, the strike less the current price times 100,000 pounds. For the lower strike put, we would look at, this is going to be less than 0, so the value would be 0. Here we'll look at several statements and determine which of these are going to be accurate. So the first one says that an option with a lower exercise price will lead to a higher payoff for the holder of a call option. Well, as we saw in one of our previous examples, the lower the exercise price, all things being equal, the greater the payoff, the greater the upside is the price appreciates above that lower exercise price. This one, as a result, is going to be accurate. The value of a European call option, which is an option that can only be exercised at the maturity date, is directly related to the value of the underlying. That's true. If the underlying is above the strike price, the option will be exercised and have a positive intrinsic value. If the value of the underlying is below the exercise, it will expire worthless. The third is looking at the value of a European call at expiration being the exercise value, and that is defined in this scenario as the greater of 0 or the exercise price minus the value of the underlying. Well, the value of the European call option at expiration is not the exercise value. It is the max of 0 if it is out of the money, or simply the price of the asset minus the strike price, which is the intrinsic value. This one is incorrect. So in this example, be looking at 1 and 2 is the accurate statements. Here we have a portfolio manager who purchased a call option, 2,000 shares at $4 a share. And this particular option is exercisable at any time until May of 2025. This notes at the expiration date, the stock was selling for $4.60 and the option was exercised. We note here that the strike is $4 per share. Stock is trading at $4.60, so we know it's 60 cents in the money times 2,000 shares, which would be $1,200. That's the intrinsic value. We need to back out the premium paid, which is $350. So the profit for this trader is going to be $850. It says that it's exercisable at any time until maturity. So it's an American call option, not a European option, which would be exercised only at maturity. The payoff at expiration of $1,200, that is correct. It says payoff, not profit. So the payoff is indeed $1,200. The profit is $850, which backs out your premium. Both of these is true. The one false statement is the call option is not European. It's an American option since it notes it can be exercised at any time until the maturity date. So to wrap up this deep dive on options, let's just do a quick review of some of the key concepts. For long option holders, long calls, bullish on the underlying, the right to buy at a certain price. Long puts, bearish on the underlying, right to sell at the exercise price. The writers of the options have the obligation and in exchange collect the upfront premium from selling the option. To calculate the profit and loss, always subtract the premium that's paid on the long side. The break even is the strike plus the premium for calls. It's the strike less the premium for puts. From a practical point of view, option strategies are often used to either speculate for those that want to take a bullish or bearish position on an underlying asset. They can be used for hedging purposes like we saw for a protective put. In this case, the investor is hedging the risk that the shares decline meaningfully and buys a put so that if the shares fall below a certain strike price, the investor in the underlying is protected from future downside. The options and derivatives traders look at payoff diagrams and risk and reward and put together option strategies to achieve a certain objective within their investment portfolio. That wraps up our deep dive on options within the derivative section of the curriculum. Look forward to seeing you next time.